All right, great. Great. Well, thank you everybody for joining us today. Happy to present this webinar here with Andrew and George from Strategic Financial. Great topic today, and Andrew and George are a great resource for both us and our team at Saratoga Benefits, and you guys as well as our clients. So, thank you guys for joining us today. Great topic, and Andrew's going to go into a lot of detail. We do have a few people on the webinar, so we everyone is muted. If you have any questions, just put them in the Q&A in the chat. George will address them, and feel free to ask them. Throughout the presentation, we can address all of those questions. Also letting you know, the webinar is being recorded, and we'll be sending out the replay following the session. And I believe it'll also be posted on Strategic Financial's YouTube page. So, if you miss anything or you have any notes, you can circle back to that, or as always, feel free to reach out to Andrew and George. So without further ado, a few introductions. So first of all, my name is Bill Webb. I'm the managing director at Saratoga Benefits. We are a benefits broker doing all things from health, dental, vision, group life, short-term disability, long-term disability, Medicare consulting, all things group benefits, and helping you guys pull together comprehensive benefit packages for you guys and your employees so you can retain and attract top quality talent and help grow your business. So as we go through the year, I'm talking to a lot of you guys at your renewals. Feel free to reach out if there's anything you guys are looking to add to your plan or any questions you have. Obviously, healthcare costs are always going up, so getting the most value is very important. And if you guys have any questions, feel free to reach out to me or Amy, and we can help you guys out with all of that stuff. So as well, we have Andrew here, who is the CEO and owner and investment committee chairman of Strategic Financial, which was founded in 1987. Andrew joined Strategic Financial in 2015 and brings over 15 years experience guiding families and business owners with full financial planning and wealth services. As of January 1st, he and his team manage over $450 million in assets. And we work with a lot of the same clients and appreciate how much Andrew and his firm bring to the table, and are more than just your typical investment firm, right? They're doing more than just managing 401ks and assets. They're consulting when it comes to things like entity structure, different cash balance plans, all those different things. So they bring a lot of value that a lot of typical advisors don't necessarily have, or expertise that they have that others don't. So they really take the time to personalize their approach for clients and business owners and run point on everything in a client's financial lives as far as their business. They work as a quarterback, handling all things from personal wealth management to business 401ks, like I said, cash balance plans, all those things, and all the things that we'll talk about today. So this ties in perfectly. And with that, I'm going to turn it over to Andrew to give you guys the rundown on the three costly mistakes that business owners make with their entity structure. So Andrew, take it
Cool.
away.
Thanks, Bill. And hopefully I'll blow everybody's mind today with some of this stuff, or at least take a little tidbits that you guys can take away. So I just want to start off. So excited to have everybody here today. And the goal is to take at least a couple of action items away today that you can implement and instill in your business going forward. So before I get into the nitty gritty, I think one of the most interesting facts is that with a lot of business owners, typically on average, 75% of a business owner's net worth is their business. It's an illiquid asset. It's not stocks, it's not bonds or mutual funds, but it's their business. And so that's why we want to focus on the business entity itself and the tax savings that you can implement by choosing the right entity and then also flowing the cash through the entity correctly to save yourself on taxes. So we want to leverage the business itself, and that's why it's so important. So I love teaching. I love sharing knowledge. So as we go through today, as Bill had mentioned, is ask as many questions. I always say that the stupidest question is the question that's not asked. So and then also as we go through this, every situation is different and needs to be run by each individual accountant and lawyer. So, and we have a lot of lawyers and accountants that we work with on an ongoing basis based on the difficulty and the nuances of each person's situation. So if you need somebody to take a look at your situation, we're happy to quarterback that for you and then work with the accountant and lawyers to do that. So topics for today. What we're going to go over is the pros and cons of the business of each type of business structure and which one you should consider. Tax saving strategies and retirement strategies for business owners. and how the differences are between LLCs, S-Corp, C-Corps, and how to coordinate your business and financial situation with your personal situation. That's always important because as a business owner, it generates all the cash flow for you. So either you're taking a W-2 or a pay stub, and then you're also taking draws. So we want to make sure that we leverage those two pieces. And then the other piece is the OBBB bill. So the one big beautiful bill. So we'll go over the nuances of that as well. So takeaways, we want you to be able to choose the right entity type, and maybe if you don't have the right entity type, then investigate the right entity type, the tax savings that you can implement, and then how to adjust your income to superfund your retirement. So if we dive right in, let's go over the different entity types. So you have S-Corps. All right. Well, I guess the main three entity types are S-Corps, LLCs, and C-Corps. And what I like to delineate here is between you have solo LLC and then also a multi-member LLC. All right, so the question is, it's which one you choose. So I want to cover some of the basic data here. So with S-Corps, you can't have more than 100 shareholders. So a lot of people who are small businesses, typically you're not going to have over 100 shareholders, so that's not a huge concern. There is one class of stock, so you can't differentiate how one equity owner and another equity owner is going to be compensated. And how the profits are going to be distributed. So the profits among the profits among that are taken from the entity must be all distributed equally per their equity ownership. And owner of the S Corp must take a reasonable compensation. So what that means, a reasonable compensation is either a salary or W-2, but it has to be reasonable for your type of job. Okay, then we're going to scoot all the way to the end here on C Corps. So C Corps requirements are very similar to S Corps. The main difference is the accounting and tax ramifications of the C Corp. So C Corps, they must use accrual accounting versus cash that S Corps and LLCs can use, and does not have a limit on equity owners, and it does not limit the classes of stock either. So you can have multiple different levels of stocks and types of stock. All right. And then with LLCs, I say LLCs are the perfect entity to start with when you're starting in a business. And it literally is super easy to set these up. We set these up for a lot of our clients. Literally takes about like 15 minutes on the federal website, and then you have to go ahead and then register at the state level. So it's super easy to do. Now, with the sole member LLC, the two differentiators here is so the LLC, you have unlimited number of shareholders, you have multiple classes of stocks, and then if you have multiple LLC members, so two or plus members or two or plus equity owners, the profit can be distributed unequally among the shareholders, which is a big difference. All right. So that's a big one. And then the other thing, just for a little nuance here, is that with this sole member LLC, the sole member LLC would be included on your personal income tax return. As soon as you add another member to your LLC, another equity owner, you have to have an individual corporate tax return for that LLC. So if it's a sole member, it could be just included on your normal individual tax return. But if it is a multi-member LLC, you have to have a corporate tax return, which just incurs more accounting fees and another way for accountants to charge you more money. All right. So I always say that it's easy to start off with the LLC, and then once your profit, so not gross revenue, but your profit of your LLC, if it starts to get around like $50,000, start reaching $100,000, then it may make sense to look at switching from an LLC to an S-Corp. And I'll go over that later as to why that may be the case. And so you can always go from an LLC to an S-Corp. You can go from an LLC to a C-Corp, and you can always go from an S-Corp to a C-Corp if you want. But it is super, super, super important. I can't emphasize that enough, that you always understand the pros and cons of switching, because there will be tax ramifications when you switch from an LLC to an S Corp or from an S Corp to a C Corp. Now, to reverse it, to go back to where from a C Corp to an LLC is very difficult, and there are a lot of tax ramifications of doing that. So I want to make sure that that is well understood there. All right. So let's look at how profits are taxed across the entities. All right. So profits of a S Corp and an LLC pass through. So the see here, we have the profits, pass through profits. So S Corps and LLCs all pass to your individual tax return. C Corps do not. All right. So with taxes, when the profits of the LLC and the S corp pass through to your individual tax return, you are subject to the federal and state income taxes. So you'll see that for S corps, federal and state income taxes. Same for the LLCs. Now with the C corp, C corps are taxed at 21% for the corporate tax rate. Okay, and then when it hits your individual tax return, there will be qualified dividends that you will see on your tax return. And then that's going to also be subject to state income taxes as well. Okay. So of these entities, and I'm taking it one step further, is that with the S Corp and the LLC, given that money is passing through onto your individual tax return, the benefit of an S Corp is that there is no taxes of FICA, so Social Security tax and Medicare tax on those profits. With an LLC, there is. All right. So S corps, you do not. C corps, you do not. LLCs, you do. Okay. So we're going to show you exactly how that costs in subsequent slides. So I always like to have people explain things to me like I'm a 6-year-old, so I like to really dumb it down. And I think examples speak 1,000 words. So let's just say your company gross revenue generated is $10 million. Okay, we have expenses, so payroll, vendors that you pay, cost of goods sold, all of that represents about $9 million. So you have a profit of $1 million. So as an S Corp or an LLC, that money, you take a draw. You just write yourself a check from the business bank account to yourself, and that is considered a draw. All right. So where it shows up on your tax return is super important. Okay. So from a tax perspective, S Corps and LLCs pass that $1 million onto your individual tax return via K1 on your Schedule 1. And you'll see that here on the left side here. All right. And then with a C Corp, the C Corp, it will actually show it in the qualified dividends. Now, the difference in taxes is that when the $1 million is passing to your individual tax return, for an S Corp and an LLC, that tax rate is 37%, which is about $330,000 on a blended tax basis because there's marginal tax brackets that are taxed at each different type of income level. Now, with a C Corp, you're taxed at 21%. Plus a dividend tax rate of 20%. And so you're roughly at about $380,000 by being taxed as a C Corp. Now, the difference, again, between the LLC and S Corp, just to narrow it down to the S Corp and LLC, is that the LLC is subject to that Social Security tax and Medicare tax. All right, so by having an S Corp, you could be saving a lot of money that way. All right. So that is like one big savings is that tip number one here is avoiding that Social Security and Medicare tax. All right, so let's look at the numbers so that we can drive this concept home. So with LLCs, any profit, so that $10 million in revenue, expenses of $9 million, the profit is $1 million. So you would have to pay up to let's just round it up to $185,000. You would have to pay 6.2% of that for Social Security. Okay, so that's if you were an LLC, and typically a lot of LLC owners that we run into, they will just take draws out of the business bank account. All right. And so when you take draws out of that business bank account, you have to pay Social Security tax. And Social Security tax, they tax that up to $184,500. And this is for 2026, since we've already passed 2025. Some of these numbers are 2025 numbers just because, and I'll explain that as we go along. But this is 2026. So you have to pay that 6.2%, which is $11,439. Okay. Then you have to multiply that by 2 because as a business owner, you have to pay both sides. So if you ever look on and if you're a business owner, you'll see that on your pay stub, you have Medicare and Social Security tax coming out of your pay stub. The employer pays the other side of that. Okay, so when you have to pay taxes on this draw as a LLC owner, you're actually you're paying the full amount. Okay, so that 12.4%. All right, then you have to pay Medicare tax. All right, they don't just want Social Security, they want Medicare as well. So that's 1.45%, which is $14,500. And so you multiply that by two, that's $29,000 right there. All right, so that's a lot of money on that on the taxes. So that's total of about $51,000. It's a lot of money. All right, and then it goes same thing for the LLCs. Now the S-Corp pays nothing. You don't have to pay any Social Security tax, any Medicare tax on the flow through of the profit. All right, so that is a super big savings right there. All right. Now, one thing is that if you do switch from an LLC to an S corp, you do have to take that reasonable compensation. Okay. And so there is guidelines that show if you do switch from an LLC to an S corp, you have to install, you have to take a pay stub. For each industry, there are different guidelines on how much that is. And there are programs out there, and we have one that we use in conjunction with one of our accountants that will establish a reasonable compensation for your business and for your role. All right. So in effect, by switching, you could save yourself money on Social Security tax and Medicare tax. All right. So savings number two. All right. This is another big one. There are many types of retirement plans. Okay. And a lot of them can be used in small companies, medium companies, large companies. But the purpose is one is to save owners taxes on their income. Okay, that's easy. It helps employees save taxes on their income. Okay, helps you accumulate cash for retirement because a lot of people don't realize, retirement does come faster than people think. It's like one day you're looking down, the next day you're looking up, and it's like, okay, now I'm 65 and I don't know what just happened. So it's important to always have your eye on retirement and keep that in line. And then, given that we're in a highly competitive space for finding really good employees, working with Bill Webb to install medical insurance or having a retirement plan so that people can save, I think those are table stakes now, and that's going to be required for a lot of companies. I mean, they're expensive, but the dividends will pay off. Okay. Now, the retirement plans that we're going to go over, 401ks, SEPs, simple IRAs, traditional profit sharing plans, and cash balance plans. Okay. Now, one thing that I would have to say is before choosing which retirement plan, it is important to work with, advisor like us or somebody else or a TPA to get the census data of all of your employees, because that will drive what type of plan you will have. Okay. So the age demographic, the number of employees, the length of time that they've been an employee, that all impacts what type of retirement plan that you will install. All right, so let's go over the different types here. So these are 2025 numbers because we still are in that period now where you can contribute to a profit sharing plan, a SEP plan for the year 2025 up to April the 15th when you submit your tax return. March 15th is when corporate tax returns have to be submitted. So just to have that little nugget there. But with SEPs, you can contribute $70,000 a year. Okay. Now, how they do this is they take a percentage of your salary. All right. So if you're making $100,000 and you want to put in 20% into your SEP, well, that would be $20,000. All right. 20% of $100,000. So you can do anything between 0 and 25%. It is the lesser of 25% or $70,000. All right. So one thing I do have to say is that they are discretionary. So you can do it 1 year. You don't have to do it the next year. But if you do it for yourself, you have to do it for everybody. So if your payroll, for example, is $500,000 and you choose to make a SEP contribution, well, that could be $125,000 if you're doing 25%. That's a big expense item on a business budget. All right. So let's just say you had $1 million of payroll. All right. That would be $250,000. So the ability for it to scale as you grow your company is not really possible. We had a client that back in the day, they installed a SEP plan, not our guidance, but somebody else. And what I always say is that it's hard to take that back from employees once you have already put that in place. So you have to be sort of somewhat forward thinking, say, hey, are we going to stay a smaller company or are we going to grow? If you're going to grow, then I would say a SEP plan is not going to be the right plan. But if you are going to say, if you were going to stay small and you're just going to have a lifestyle type of business, then it may make sense to do a SEP because they're super easy to implement, install, and run on an ongoing basis. All right, because it's like if you give your employees 25 cookies and then you take 15 of those cookies away or 20 of those cookies away, they're not going to be happy. So again, they're really smart. They're really good for small companies, companies that will want to stay that size, and they are federally tax deductible. Now, in the state of New Jersey, SEP plans and simple IRAs, they are not deductible. Some states they are, and some states they're not. So you just have to check with your accountant on that. All right, now we have profit sharing plans, very similar to SEPs. Again, the same rules, all or nothing. Now, one difference is that you can actually create different groups of people in profit sharing. So in the SEP, it was everybody across the board, no matter if you were a secretary or if you were the business owner, you all got the same amount. If you install a profit sharing plan, you can actually compensate different groups differently. So if you have a management team and you want to compensate them more than some of the clerical staff, you can do that. But there's different testing that you have to do. So it's important to work with ourselves and the TPA. TPA is the people that actually run the numbers for us to see if you pass the testing. So it's important to do that. But that's the main difference between the profit sharing plan and SEP. Simple IRAs, they are super easy to set up. I always say this is like if you want to sort of dip your toe into the water and you want to get a feeling of how operationally it works, this is probably the best plan to go for, knowing that like, hey, you will want to grow. And it's ideal for small employers and owners who are making about $100,000 to $150,000. That's when I would say it makes the most sense at that point. You can defer so how it works is you defer from your salary into your simple IRA account of the $16,500, and then plus a catch up of $3,500 if you're over the age of 50. And then they have this 2% non-elective and 3% elective. So what that means is that the non-elective, if the employee is not deferring, so this is not elective, if they are not deferring money from their salary into their simple IRA, then they still get a 2% match. Okay. So even if they're not contributing to money to their simple IRA from their salary, they're not participating, they still get the 2% no matter what. Okay. The other option is you make it a 3% elective match. So what that means is that if the employee is actually making deferrals from their salary into their simple IRA, they will get the 3%. If you're not making any contributions to this simple IRA, you get no match. So there's a benefit of that. So you need to sort of assess what is the participation of your retirement plan, and that can drive some of these decisions. All right. But so employee contributions discretionary, but must make a match of some sort. All right. And this, again, all of these are federally tax deductible. Now, then you have your traditional 401k. The traditional 401k is slightly more difficult to administer. So like with the simple IRA, it's pretty easy to administer. It's inexpensive, may cost like $1,000 to $2,000 a year. To implement a 401k, it costs about like $3,000 to $5,000 a year to run and manage, and requires testing. So what ERISA, who manages all the retirement plans, it's almost like the IRS of retirement plans. But they want to make sure that the management level, the people that are compensated the most, are not the ones who are just benefiting from the plan. Okay. So there is different testing that you have to go through when you're installing a 401k. So For the deferral amounts, there's a step up in the deferral amounts from the simple IRA to the traditional 401k. You get, and this is for 2025. The numbers are $23,500. They're slightly up for this year, plus another $7,500 if you're over the age of 50. There is a super catch up from age 60 to 63, which we can talk about or speak about later if you have any questions on that. So for a total deferral amount of $31,000. There can be, and doesn't have to be, a match. Again, it depends upon the participation in the plan to pass that testing. So typically, the matching is anywhere between 0 to 5%. We typically see about 3 to 4%. And it can be designed to be somewhat flexible. Most cases, there is some level of match. And again, it's federally tax deductible when you do make those deferrals. Now, in the state of in New Jersey, they are tax deductible for the state of New Jersey. Simple IRAs are not. So with high income earners, we always say to go straight to a 401k if you're in the state of New Jersey. PA, they don't allow you to deduct any contributions in 401ks or simple IRAs, so it doesn't really matter there. All right. So the conclusion here with these types of plans is that if you are small and you don't plan to grow and you have employees, about two to five employees, a SEP plan may be the right plan because it's just super easy to do. If you plan to grow, or SEP or profit sharing might be the way to go. If you plan to grow and you just want to dip your toe in the water, simple IRA may be the first place to go just to get an understanding of how it works. But if you know you're growing at a faster rate and you want to make it more customizable, then a traditional 401k would make the most sense. Now, with a 401k, you can combine it with other retirement plans. Okay, you can't do that with a SEP, you can't do that with a simple IRA, but what you can do with a 401k is you can combine it a 401k, a profit sharing plan, and a cash balance plan. Okay, so one thing I would say is that when you combine a 401k and a profit sharing plan, you can contribute up to $77,500. Okay, because you have the $70,000 from the profit sharing or the deferrals, and then plus the catch up. Okay, that's huge there. Now, what we can do is we can do 401k, profit sharing, and then add cash balance plan. Okay, now this is like if you have consistent cash flow, this is where you would really like to go. I mean, the Wall Street Journal even did an article about how all these physicians, because they have consistent cash flow and people are always getting sick, that they can fund these things, and you typically have to fund it for a minimum of 3 years. Okay, so a real life example that we had where you put hundreds of thousands of dollars of this. We had a client who was able to put in $280,000, and of the $280,000, he was able to get $213,000 of what he contributed. All right, so that's like a big tax saving. If you're at the 37% for Fed, and let's just say you're at 10% for state, and right there you have 47% that you could potentially save. I mean, you're talking about hundreds of thousands. You could potentially a couple of $100,000. All right. Now, before you even go down these roads, it's like you need to have your trusted team like Bill and myself that can help you walk through these scenarios and understand them and see what makes sense for you, because not all of this always makes sense for the plan. I mean, they sound great, but it's like it all comes down to the facts and the details. All right. So that is tip number 2. Now, tip number 3 is PTE. These are pass-through entity payments. Okay. And this is one of the most effective ways to save on taxes. All right. So just big concept here. PTE payments are a way to pay your state estimated tax payments. So everybody has to pay the state government. In New Jersey, you have to pay a lot of money. California, I know there's people on here from California, but you can use your business to pay for your state income taxes. All right, and that is typically on the profit of the company. So that example that we had before, where you had $1 million of profit coming through the business, you can actually pay your state estimated tax payments through your business, which will deduct it from the profit for federal tax purposes. And then you get to claim it on your state income tax return through this pass-through business alternative income tax credit right here. Okay. Now, there are certain entities that allow you to do that. S-Corps. And this is just specifically for the state of New Jersey. So it may be the same because everybody's pretty much doing the same thing. For the state of New Jersey, S-Corps, you can do that even if you're a sole member S-Corp. Okay. If you're a sole member LLC, you cannot do it. If you have multiple equity partners in your LLC, you can do it. C-Corps, you cannot do it. All right. So this is, if your accountant is not doing this, then we should discuss about whether your accountant is the right person for you and whether we should look at somebody else. But if you haven't been doing it, check with your accountant, see if they've been doing it. And if they haven't been doing it, we should talk and potentially find you somebody else. All right. And like in meeting with different clients that come in and prospective clients, you'd be amazed how many people are not aware of this and don't actually use it on an ongoing basis and really take advantage of it. All right. So if we put all of these 3 different tips together, I'm going to give you a real life example that we helped a client of ours. So a client of ours in this example, they had a profit of their business. So they were an LLC. They had the gross revenue coming in. They had their expenses. So they were just taking business draws out of their LLC. And so what we did is we said, hey, owner, why don't we shift you from an LLC to an S-Corp and take out a reasonable salary for you? So in his sense, we had to take out about $350,000. So it reduced his profit to $989,000. All right. So then what we had to do, and then because he changed from an S-Corp, he made a sub S election on their tax return. He was able to avoid Medicare tax because there's no top threshold. With Social Security, it was about $185,000. Medicare, there is no threshold. It is taxed on your full income amount. So that's 2.9%. So he saved, just by doing that, $28,000. All right. Then he had additional Medicare tax because once you make over a certain amount of money, they charge you an additional Medicare tax of 0.9%. All right. So that's $8,900 that he was charged. Then what we did is we implemented a 401k and profit sharing plan. So statewide, he was able to save $7,000 in state taxes. And then federally, because he was in the 37% tax bracket, he was able to save $25,900. And then we worked with his accountant, who was somebody that we introduced him to calculate how much he could pay in PTE payments. And his PTE payment reduced his profit federally, and he was able to save $23,796 from that. So that's a total of approximately $94,000. So think about that. If you were able to save $94,000 and you took that $94,000 and you invested that in the S&P 500 at an average rate of 7% per year for 20 years, that would amount to $4,658,000. That is insane. That is a massive, massive tax savings. All right. So I wanted to give you, because I want to make sure that everybody gets real life examples. I think it's very important to use that so you can see how it actually can be implemented. All right. So just to recap real quick on tax savings tips before we go into the one big beautiful bill. Investigate if you have the right entity structure. I think that's a simple one that you guys can do. Identify a retirement plan, see which one would make the most sense and leverage that as much as possible. And then contact your accountant to make sure that you're making PTE payments to the state. Okay. All right. And then I know I've been talking a lot. If anybody has any questions, please feel free to submit them and we'll try and get to them. All right. So next, the one big beautiful bill here. So the one big beautiful bill that was enacted July 4th, everybody who owns a business, depending on the type of business you're in, you get what is called a QBI deduction. And you'll see that on your personal income tax return. That is called what that stands for is the qualified business income deduction. So it's for business owners. It's a way for the government basically to spur more growth in people starting small and mid-sized companies. You get an automatic 20% deduction on the profit that flows through your company. So we want to make sure, you always want to make sure that you're taking that you're getting that deduction. The next one is the expanded exclusion. It's the Section 1202. If you're thinking about, and we help a lot of clients sell businesses, is that if you're thinking about selling your business, you have to switch from an LLC or an S-Corp to a C-Corp 5 years before your exit. And so what this does is that this will exclude $15 million of a gain from the sale. So let's just say, for example, you sell your company for $20 million. That's a ton of money. And you, 5 years ago, you're like, I want to sell my company. I changed to a C Corp, and now I'm selling my company for $20 million. Then you get to exclude $15 million out of that. That's huge. But you have to make sure there's certain types of business. You can't be a service business. You can't be a restaurant. There's other sorts of limitations to that. So it's really important that you know whether you're allowed to do that before you transition to a C Corp, because it may not make sense. One other thing is that in the tax bill is that they allowed 100% bonus depreciation for qualified capital improvements, which is huge. Before, you had to amortize that over multiple years. And then the last one here is the immediate expensing of R&D, research and development. So before, that had to be amortized over 5 years. Now you can expense that immediately, which is super nice. So again, I really appreciate everybody for joining today and attending and taking the time out of your day. I know that you're busy. A little insight to what we do. I'm a certified financial planner. We work with business owners, and we are the quarterback working with both business and personal to make sure that you achieve your goals. And just bringing it back full circle is that with a lot of business owners, a lot of your net worth is in the business. And so being able to leverage the business and then mix that with your personal is going to be super important. Being able to review both that, because a lot of advisors, they don't do that. They're only are interested in the investment assets. Okay. So typically what we do is we have a 7-month detailed financial planning process. And one feedback that I get is like 7 months is a really long time, but it allows us to dive in deep into your situation and uncover everything to develop this plan for you going forward. And what I do hear out of it, despite the long period of time, is that it reduces stress, reduces anxiety, and it gives them a lot more self-confidence in their path going forward. Okay. So how we help business owners, we help you determine whether you have the right entity structure. We try to save you on taxes. So we work with your accountant or accountant that we use on an ongoing basis, and we're constantly speaking with them throughout the year. We have an outsourced C-suite, so if you need somebody to help you with your finances, with your numbers, understanding your cash flow and projecting cash flow forward, we have a chief financial officer, somebody who helps you with marketing, because like that's a big one, getting your name out there, name recognition. Chief revenue officer, making sure that the pricing of your services or your products is right. And we have our accountants and lawyers who are super awesome and super great, very detailed oriented. And then we go through profit and distribution strategy analysis, determining how you should flow your profit that you will get through your entity or any multiple entities that you have. We do a lot of benefit planning. So with Bill, in conjunction with Bill Webb, doing the medical insurance and other benefit planning, and the business continuity plan. I mean, again, you're putting 75% of your net worth is in your business. Then we need to make sure if something happens to you, is that whether your family and whether they will be compensated if something happens. And then also on exit, it's like everybody's thinking, well, exit is 20 years, 10 years down the road. I don't need to worry about it. That will come very quickly. So let us know if we can help. This is my email address here. It's alife@sfcorps.com, or phone number, Bill Webb at SaratogaBenefits.com. So happy to connect, help you out, give you unbiased opinion. We're very transparent. We'll tell you if we can help you or not. We'll be sending out an email to all of you guys with the recording and just asking if you guys want to connect or not. And then also we have a lot of videos out there. So you go to our website, you can go to Saratoga Benefits website as well. We're on Facebook, so Saratoga, LinkedIn, we're both on there. So we have a lot of educational pieces. Follow us on YouTube, Instagram, trying to get into that whole thing, which is pretty amazing. It's totally different than I'm used to. And yeah, so Bill, I'll pass it back to you. Super I appreciate you setting this all up, Bill, and give us the time
Yeah,
to
absolutely.
share a little
Yeah,
knowledge.
thank you, Andrew. I appreciate it. So, yeah, as Andrew said, we'll be following up and everything. Feel free to reach out to me and Andrew if you have any questions about this stuff. Happy to be a resource for you guys. So, I'm sure we'll be talking soon with renewals coming up and everything. But again, don't hesitate to reach out off renewal cycle if you have any questions about both benefits, 401ks, any of that stuff. We're happy to help and open up our Rolodex so we can make connections for you guys and give you guys some trusted resources like the strategic financial team to help you guys grow your business and get organized. So again, appreciate you guys taking the time today and have a good rest of the day.